Good afternoon. This is Coach Mike from WinningStockCoach.com, presenting to you today our market overview for the upcoming week ahead, beginning on March 17th, 2014. If you've been following the market overviews that I've put out the past few weeks, actually past few months, I encouraged you not to be alarmed. We're watching the S&P 500, which is the SPX chart that you see here on the screen. We're watching in the shorter term channel that started since the inception of QE3. And I've been talking about a Fibonacci time series that led us to the week of March 3rd, in which I said that I expected the market high to be made during that week. As it came to be, the market high was indeed made the week of March 3rd. And this past week was a bit of I won't even say a brutal week, but it was quite the down week for the indices in general. And what we found is an actual failure. And I'll show you the charts I'm using with Thinkorswim. This is a weekly chart, a weekly 5-year. And you're going to see that it kind of just goes with the closing price. And when I switch the chart, you'll see a different price posted. And I want to show you that in relation to where we are with the lines here on my chart. This short-term channel, the trend that caught several bottoms, including the big bottom in January. And also showing you this longer-term channel we had, and using the weekly chart to do that. Now I'm going to switch to a 1-year daily. And the reason I wanted to show you on the weekly where those lines came from is they were based on the close of this mountain chart for the weekly candles. And as you can see when I go to the daily chart, there's 5 days in each week, each trading week, and therefore you get some differences within those weekly channels. And also you see that after hours and into the futures trading, the S&P 500 closed down at 1841.13, which actually failed this line here, which was from the weekly swing high of 1842.24. So we did get a failure of the prior high after making a higher high during the week that I had expected would bring the top of the market. And I'll explain this tool a little bit, the Fibonacci time extensions. This tool basically mathematically equates the duration of a trade sequence. I used the same tool back in 2008, and it told me the week the market high was made then. So hey, why not trust it? Why not trust it like I trusted it back then? And now that does not mean I'm saying the market's going to crash, but if you're following the global economic news, the global news in general with issues with Russia and the Ukraine, just a whole bunch of stuff, makes you believe that there's some fear, some timidness. So we may see some continued selling, especially since we closed on Friday below our prior high on what was, if you remember, a couple weeks ago when we talked about the potential of what could happen from that pattern. We talked about the potential of a pretty nice breakout based on the parabolic pattern in general, and we got that. And we talked about last week how we would look at that line as our support point and would not want to be failing it. Now, overall, as I switch back to the weekly chart, the S&P 500, and I'm again going to tell you in full confidence, just like I told you the past few months, your long-term investments are okay so long as this channel holds. So where's this channel at for the upcoming week? Well, if we go up here, we're actually going to see that the channel puts us at about 1846.30s, so the 1846.30 range. And I've got a couple other targets I've drawn on here with another Fibonacci tool called Fibonacci extensions. of potential areas I believe the S&P 500 could fall to should it fall out of that channel. Those prices 18.26 and 17.69.43. Again, Fibonacci tools are mathematically equated, so I use them quite frequently when targeting prices for pullbacks, so I can buy long, or use them for targeting prices for pullbacks to go short, and also when I am long to project a price target. And I trust them a lot, so going into this week, I'm monitoring those prices. I would not be surprised to see our week start out, depending on what goes on with the Crimea vote that they're doing. At this time, it's 1 p.m. Eastern Time on Sunday, March 16th. So I haven't seen yet the actual tally, the results of that vote that was done on whether they would secede from the Ukraine and become part of Russia. I know the U.S. has threatened that they wouldn't recognize it. Most of Europe has said the same thing. There's a lot of fears in the news coming out of Poland. So at this time, going on that, and I'm one of those prepare for the worst and trade for the better type of guy. And in that preparation, I would not be surprised to see a bit of a gap down in the markets tomorrow from where we started out, or where we left off on Friday. That being said, if things settle down over in Russia and Ukraine, and some tempers tame a little bit, we actually could see a kind of flat open, and who knows from that point. So a lot will be depending on tomorrow's open and what happens with the global news and how it could affect our markets. But the big thing to understand is, as we do continue to see the Fed tapering from quantitative easing, we use this channel that started as QE3, the third initiative of the stimulus, was put in place, and we are left looking at that as a point where, if it fails, long-term investments are going to be best to do one of two things: reduce position sizes or sell. That would be choice number one. Choice number two would be to take in-the-money put options. In-the-money put options, remember, put options give you the right to sell at the strike price. So depending on your position, let's say you're holding a stock that's currently at $25, you could look to take $26, $27, $30 calls, something in that range, or puts, and because you would hold the right to sell those shares at that price, you would not have to be scared out of a position should the markets fall. To me, that's actually a better way to do it than just panic sell, because with an options contract, for example, with those put options, you would buy one put for every 100 shares you are holding of an optionable security. This usually leads to you having between 12 and 18% of the entire position into an options position. What I like about trading the options in this way is, if you lose money on your puts, it means your stock went up. And generally, if you're trading in the money puts, where the strike price is above the current price of the security, then what you find is a ironic anomaly in correlation with the prices, where whatever you lose on your put, you gain in your stock, fairly accurately enough to give that as the example. And whatever you lose in your stock, you gain in your put. What it really is, it's like car insurance for the stock market. We pay car insurance hoping to never need it, but so that if we were to wreck our car, we don't have to come out of pocket with larger sums of money other than our agreed upon deductible. The deductible would be the premium you'd be paying for those puts, and no more. So it's a pretty good deal overall. Rather than just panic sell, you could buy the in-the-money puts on your long-term common stock trades, and rather than panic, you could trust that you have a right to sell at that strike price. So the S&P 500, overall, a weak close on Friday, a bunch of things looming that could lead us to the type of pullback that we saw in January. And as much as I'd hate to see it, I'd actually also like to see it as well, because once the markets bounced in February, it gave a nice bounce, better than we had seen, November, December, as the markets kind of hovered sideways and made smaller bounces for smaller terms. Those consolidation patterns we saw. The pullback in January gave us more of that volatility in the market that we had, back August, September, October, actually almost all of 2013 up until November, where we never pulled back. So it's healthy to get a pullback so long as you don't make a lower low. If we were to make a lower low than this pullback that was made here, then obviously that would be bad, but we wouldn't have to let it get that bad, because we could use this channel that shows us that we've held within this channel on every dip so far since the channel was created, this pink one right here. And rather than waiting for a lower low that could be clear down here in the 1780 range, we could safely look to exit. Should we give up about 1724 or 1824, I'm sorry. So there's no reason to allow it to make that lower low based on the trust and confidence of how this channel line caught the bottoms every time. And for long-term investments, I always like to trade those in relation to my stop and not a potential target. Because if you trade it to a potential target, you never really know where the high is until you're looking at it from below. And if you're to sell long-term investments on any high, if it goes and makes a higher low, chances are you didn't sell on the high. So I trade it in relation to my stop, and with ascending trend lines that are moving upwards, each and every day that I hold, my stop gets higher. So therefore, if I were to have to stop out of the trade, I would be stopping out of the trade still with profit. So that's one thing to be looking at as far as the S&P 500 goes. You can monitor this chart with any broker, SPX. Some brokers you have to put the dollar sign in first. It'd be $SPX. With TD Ameritrade's Thinkorswim platform, simply SPX. And it's very, very important that you keep an eye on the S&P 500, because many of the stocks that you see trading will actually trade in correlation to the indices that I'll be going over in my market overviews and that I've gone over regularly in them. We're going to switch it up now to the DJI chart. This is the Dow Jones Industrial chart. Again, we're with the weekly 5-year. We see our channel that's gone, it actually goes down to the market low, but because that was a couple weeks more than 5 years ago, you can't quite see it. But I've had the channel, if you watch my other videos, we've been on it and consistent with this channel's placement. The difference in the Dow Jones Industrial Average and the S&P 500 is the same in the difference between the S&P 500 and even many S&P 500 stocks, which was a weird anomaly. On this past run, the S&P 500 made a new all-time high and a higher high from its last. The Dow Jones Industrial actually made a lower high. Not only did it make a lower high, but it made that lower high, and as this week is registering, stopped right at this swing high point, which was our support. Once we came back up and broke it, and you can see the little retest of it here, as it broke it, pulled back to it 1 week, and then shot up. But I had talked about this over the past month or so, as the DJI was falling, that we really had to watch for it to make a lower low than this period here, and it did. And that should it make that lower low, we would have to expect a lower high. Now, if we look at some big stocks like Goldman Sachs and Visa, IBM, all of which are making lower highs right now and pulling back from those lower highs, it begins to give you a look at a market that, for the first time in quite a long time, really since November of 2012, has made a lower low and lower high. And really since 2011, the first time that that lower low was created on such severity of a pullback. So you do have to kind of take that into account, that during this time you need to be prepared for possibly even a return to this 5-year channel line that marks the bottoms that we've seen since the market lows in March of 2009. Now, if we switch this over to a daily chart, you're actually going to see that we closed the day below that swing point at 16,065.67. Again, the weekly chart just shows the actual close of the day and not how it traded after hours, in the 4 p.m. to 8 p.m. time period. So we did get a couple dollar decrease, a few dollar decrease actually, into the end of the day from where the 4 p.m. close was on Friday. So in the after hours, we actually did come down, fail that swing high, and a couple price targets that I've put as points where it could bounce from. Now remember, nothing goes straight up and nothing goes straight down. That's one thing a lot of people don't realize for some odd reason. And you can see it very clearly on this chart. Things went up and they went down a little bit and up and down. And you want to, in a bullish market, you want to be monitoring for higher highs and higher lows. And you see times where you get severe pullbacks and you start making lower lows and a lower high, a lower low, a lower high, but then a higher low, higher high, higher low, and it starts going. And again, we had this fall in 2011. And to be quite honest, at this point, this here is actually what I'm kind of expecting, that July through September 2011. Now, I'm not panic selling on anything. I've actually had my plans in place and exited most positions there at the beginning of January or late in December. So other stuff, I've got my leverage with put options and whatnot. But the chart pattern's very similar here that it was here and that we're seeing right now. And with everything we got going on globally, I would not be surprised to see our market pull back and the Dow Jones Industrial hit 15,622.56 or 15,258.14. Both I used with the Fibonacci extensions, mathematic calculation based on a 3-point. I marked highs, lows, highs. This higher target was based on closing prices only. The lower target was based on absolute prices. The absolute high that was made, the absolute low that was made, and then the subsequent absolute high. So it did give a difference in the projections. So what I mean by this is I wouldn't be surprised to come down sometime during the next 2 to 3 weeks and hit this 15,258.14, but still maybe bounce up and close at this 15,622.56. Now, with these as bounce points, I want you to understand, like I was explaining, nothing goes straight up or straight down. These are points where if you don't sell into these higher areas here, that you would then look for it to bounce and more than likely just return to this area for the next high. Now, in the case of this right here, if it got really severe, it could take quite some time just to return to those price levels again, which is something you'd have to weigh if you're willing to hold for that return, or take the put options 4-6 months out to protect you for that in case it doesn't come back. Because if for any reason, we don't hold this line, then I personally will have to kind of get on that bear train and say that the market would truly be correcting, or you might hear it on the media as crashing. But as far as I'm concerned, so long as this channel holds, the one that was been set since the market lows in March of 2009, then I still believe we are channeling or trending in a perfectly healthy manner, and that the trading that persists will simply be between these two lines. this line serving as support and this line always serving as resistance here on the top. So if that fails, yeah, I'm more of a realist. I wouldn't, I'm more of a natural bull in the trades I make, but I'm kind of a natural neutral. I'm not one that falsely believes that the market will just always go up and up and up and up and there'll never be a red candle. And I'm not one that falsely believes that. I'm one that believes that the bulls can make money and the bears can make money, and I can make twice as much money by trading with both of them. So I'm more of a market neutral, and that allows me to see the charts for what is happening and not for what I want to happen on them. And that's a very important point to be making, because a lot of people will always convince themselves that, well, I can hold in case it hits here, or maybe it'll hit this point. And they're changing their trade plans throughout the process of the trade and straying away from what their original plan was. Typically, those people either lose a whole lot of money or they hold for a very long time just to break even. So just understand the basic supports, resistance levels that I'm presenting here. And again, I just want to say again that in no way, shape, or form, since I've been releasing these videos to people outside of my paid subscription service, the Coaches Roster, have I ever tried to be like the media and scare you out of something. I've actually just tried to counter the media and say, this is what you need to look for. This is where you might want to sell, because this is what could happen if it falls below that point. And as you've seen, like with our SPX chart in that channel we've been following, every time the media ends up trying to scare you the most, ends up being the best time to buy. So if you follow the technicals on these indices and correlate those to the individual charts that you are trading, the individual companies, the individual securities, however you want to call them, the individual tickers, you'll find a lot of commonalities in the ups and down moves. And when you see the indices fail support levels, you have to expect that your stocks will too. I can tell you this from experience, that it doesn't matter how strong your stock is when the markets pull back. In 2008, the strongest stocks in the market pulled back too. So don't get a false belief that, Facebook is super strong, or, there's nothing that could take down Apple, or, Google's a Goliath, or, Netflix, there's nothing that'll ever happen, because, hey, wasn't too long ago we were buying Netflix at $70, $58, good buys. And people never thought those could happen a year and a half ago when it fell from way, way greater than $200 then. So have an understanding of your stock's price to earnings multiple. Stocks that are already well overinflated on their price to earnings multiple are more vulnerable should the markets pull back. A stock that's trading at a low price to earnings multiple has the fundamental value to fall at a lesser rate, I guess would be the best thing to say, to fall at a lesser rate. And with that being said, there's just very, very simple things that you can apply and watch for your own trading plans, your own trading styles, to allow you to be prepared for if it happens. Not when, if. And so you don't have to panic. All you have to do is make a decision that you've already prepared for. I'm going to take a look now at our small cap index, the Russell 2000, the RUT chart. Again, the 5-year weekly chart, coming into this new high, just like the SP500. And again, closing right at our swing point here. Small caps have been very, very powerful, and I actually told you guys back in January that I just felt that the risk of a January pullback was not worth the reward of barely being able to squeeze out more from phenomenal small cap plays over the past year and a half. So I had exited most of my small cap positions in December, January, simply because I looked at it as if the market pulled back, if the bears that have been plaguing the news for quite some time now were right, then how much further could this really go? And while it went up and I missed a little bit extra on some of the stocks that I sold did not go up. They've only gone down since that were small caps. So it's been kind of an ironic thing to see the indices making new highs and many of the stocks not. But at the same time, we're seeing these indices fail key support points again. And we have to be aware of what possibilities lie ahead. If I had to pick a couple bounce targets on the Russell 2000, I would, again, the same way I explained that I picked them for the SP 500 and the Dow Jones Industrial, two different projections based on closing prices and then absolute highs and lows, 1151.44 and 1113.50 would be potential points, meaning could it come down and hit 1113.50 or roughly thereabouts and then make a weekly close back at 1151.44? Absolutely. And that's kind of what I'd look for in my expectations for how I may trade. In fact, if it comes down here and makes a bounce, I would look to make some trades, not investments, trades for that bounce and how it would correlate back to the individual securities that I trade that follow this indice. Now, this is something I thought about adding this to the market overview in the last couple weeks, and I decided this week was definitely a time because I was actually expecting gold to get a little bit of a pullback. It struggled with a double top resistance point it ended up being a couple weeks it struggled with it, and this past week it broke out above. This line right here that I'm moving my crosshair across is going to serve as your support point for gold. If the markets start falling quite hard and any type of news that correlates with war comes, we could actually expect quite the price increase in gold. You really have to play it first, and I know this line's not attaching here because it's based on the close, and I've got it here on a daily close. It's set from another chart, and it just transposes on any different time frequency I do, but would really be looking in that 136.70s, 136.80s range for the first resistance point on gold. But you notice this long down channel line where we had our high on gold, and we had a subsequent touch here. What you would see here is the potential for, if the S&P 500 really fell apart hard, and if the Dow Jones Industrial fell apart hard, and if the Russell 2000 fell apart hard, gold at least has some great potential to, if not maybe return to the highs, at least return to this line, which is significantly higher, and may mean that we could see gold in that price range of, it'd be 1500, but the GLD chart, the Spider Gold ETF, is one that's tradable, and when markets are weak, I personally like to go into metals. I don't like mining companies so much because they're still a stock that has all that same hoopla involved with all the markets in general. You could have a mining accident. You could have the fact that metals have been down and they go to report earnings when metals are up and they were selling product back here, so they may be missing their estimates. Where the GLD chart and the SLV, the silver chart, are simply correlated in association with the physical metals themselves. Personally, just to kind of throw a potential trade out there I'm looking at is, looking late July, monthly, maybe even August, September, call options. Kind of a different way I'm looking to trade. I'm going to trade a few different strikes because some of those may end up being, with a call, it's a right to buy shares at the strike price as opposed to puts as a right to sell the shares. Those may actually be executed into shares later on, but higher strikes that I may be buying to target an area is simply going to be traded for potential profit in buying and selling the contracts alone. But I truly believe that you could be looking out late summer, early fall at a 145 to 150 target with call options and such. And even if you were to just take the common shares, I've always liked to take positions in metals not necessarily mining stocks, but metals, when I believe the markets are weakening. I don't think you should panic and sell everything you own. Again, I said earlier in the video, you have options to leverage yourself through put options. And I always think that's a better decision for you, even though it'll have you holding a stock that's falling. It'll have you smiling as you're doing it because you're going to realize that you're not losing any money as it falls. And if it makes a suitable bounce where you would only want to buy it again, you could actually just sell those put options and take the profit from it, which would then be, to me, viewed as free money. The profit only from the put options, not the capital initially put in. And you could buy more shares of those stocks that you love and strengthen your position even a downtrend. That's actually how I like to trade a downtrend. I don't like to wait for a bottom, try to predict a bottom, and then dump my money in it with very, very high risk. I like to stick with my stocks, and the way that I can assure I'll be in it at the bottom is if I never have to sell, but I'm never losing the money on them because I'm leveraged through put options. And by doing that on every significant bounce that you may see on a chart, I can sell my put options and put that profit into more shares. Because that profit's money I didn't have, it literally has me viewing my new shares as free shares, a gift from the stock market. And therefore, in how I personally calculate my view of my positions, it significantly reduces my average because I added to it with money that I didn't have it before. So now I've got the same amount of money in the stock, but yet more shares than I held before. And to do that, you can assure yourself you will be in at the bottom. Now, if it goes into the expiration of your contracts and it still doesn't look like it's done falling, you get to fall on that saving grace of, hey, I can sell these at that strike price that was already well in the money when the fall started. So you don't have to fear, you don't have to panic sell. Let those that haven't taken the steps that you're taking by just watching this video to help you prepare, let them panic sell and let them miss out. Or send the link to this video to friends and family members who you're afraid may panic so they can develop a plan too. Because that's my goal with this, is just to prepare you for what you may see. Because when you simply listen to the media, you find that over the past 2 years, every time they induced panic in the market was the best time to buy. And every time they informed us that things were great was the best time to sell, reduce, or to leverage via put contracts. And you can see that here, going back to the SPX chart, the S&P 500, when we got into August, and they scared us with, the taper was supposed to be so bad and it was going to kill the market, and we were waiting on that decision, and and then the decision came and we kind of shot up and just made a minor pullback. And then they scared us about the government shutdown and how that could really hose us over. And, at the 11th hour, the government came through and back to work, here we go. And the markets came up. You see, they wait until the markets are already down to push them down just a little bit more through their propaganda, through their antagonizing of the average Joe trader. And all that's happening during that time is the boosters that fund those networks are sitting here waiting to buy your shares. And by the time you realize the market's bounced, you're having to rebuy at prices higher than where you sold. And then your broker's getting a lot of extra money, so your broker's a fan of this because you're buying and selling and your broker's making money every time you do. At the beginning of January, the media told us that everything was great. There's not a fear in the world. And the next day, the markets fell and began falling very hard for a month. When we got to the bottom, the first week of February, people I even respect a lot, Jim Cramer on his TV show told people for 2 weeks, just wait till the non-farm payroll data comes out the first Friday of February before you do any buying. So what did they do? Monday, Tuesday, Wednesday of that week, the markets went flat after they had fallen. They went flat after falling. And let me take it to the daily chart and I'll show you this. But right down in here, after falling, markets went flat. The sad thing was, the day they really shot up the most was Thursday. After the media told us to wait till Friday, till the non-farm payroll data came out, and then buy. And then when that data came out, even though nobody understands how it was actually good because most of the line items on it weren't good, it shot up even harder and faster to the point where you're looking saying, man, I'm really far off the bottom if I buy here. The sad reality to the truth of the media that many people put their faith in is if you listen to the media, you didn't make the big returns on the SP 500 that they're talking about now, because they scared you out in August. They scared you out in May. If they didn't scare you out in May, they scared you out in August. And you never found a suitable opportunity to buy again. And that's why I started sending these videos out publicly and not just to my paid subscribers at the coaches roster, because the market overview videos, I believe that, I don't need to hold those back from anybody. I don't send out my watch list videos where I dissect individual charts to my paid subscribers. And, I don't allow the access to the chat room unless they're a paid subscriber to the coaches roster. But I'm not about to be a selfish enough person to not want you to make money. This is Coach Mike from winningstockcoach.com, encouraging you to have a plan for your trades and to watch the correlation in the indices and the stocks that you're trading. To understand that there's never a time to be scared of the market. There's never a time to panic. There's simply a time to make a decision based on what charts are doing. And if you followed this from how I explained it, looking for lower lows and lower highs, and following this channel per se on the S&P 500 or the lower lows, lower highs on the Dow Jones Industrial, had you followed that since the beginning, the media would have never scared you out of a trade or an investment, however you wanted to depict or the semantics on it. And never once have I tried to tell you that you need to sell, and you need to be scared and panic. I'm simply telling you that if it fails, this channel line here, you need to be prepared to make a decision, because we don't have much holding it up. And we could see the S&P 500 down under 16,000, or 1,600, I'm sorry. And that's just a reality for how stocks trade, how charts move. And it's a reality for the situation we're in. I've said it since December actually I've said it since October, November, that some of these companies reporting phenomenal earnings, their earnings numbers are they're padded by things that aren't healthy for the economy. We saw Macy's, okay, they had an earnings beat recently, but they cut jobs. They're going to close stores. And we see that with a lot of things. Companies aren't investing in themselves to give us as investors hope for the future. They're making cuts to make numbers better right now. And that tells me personally that the fact that all these job numbers that the media makes a big deal about, which I know and you know, are primarily part-time work. When I see local hospitals where I'm at here in Tampa, Florida area, I see local hospitals that they're giving nurses and CAT scan, radiology techs, all their former full-time employment, they're moving them to part-time employment. Yes, they're hiring more people because of it, but they're doing it because of the Affordable Care Act and regulations with that and the money it costs. I see local businesses that used to have 5, 8, 10 full-time employees now having 20 to 30 that work 10 hours a week. And I see the American middle class working 2 to 3, maybe sometimes 4 jobs just to get by like they were before. That's not recovery to me. That is propaganda, inflation, in the stimulus that we've had overall, and actually borderline, if you follow the currency, borderline deflation, which is very, very dangerous for our currency and could cause big pitfalls in our market. Because of all this, and then you add to it the Russia and the Ukraine, you add the Syria stuff that's still kind of going on. It hasn't left. The North Koreans firing Tomahawk missiles today and last week. The Malaysian airline that nobody can seem to find, even though my time in the military, I know that we had satellite recordings that could find somebody in the jungle 6 months ago and day by day track every step. So how we can't find an airplane, I don't know. We have to be prepared and have a plan. And rather than panic, we need to execute based on our plan. I'd like to encourage you to visit my website, winningstockcoach.com. You can sign up for my free newsletter. It's called the Practice Squad. And if you're interested in joining us in the chat room, filled with constant educational resource, regular evening webinars, trade plans and such are provided to the members. Sign up for the coaches roster. Join me in the chat room live all day, every day during market hours and well into the evening. I'd love to see you. Again, this is Coach Mike from winningstockcoach.com. God bless and good luck in the upcoming week.